Welcome back to the channel. Mike, the mortgage guy here. Today, we're gonna talk about how to take advantage of the equity in your home. Two main options that we're gonna discuss today: cash-out refinance and a HELOC, also known as a home equity line of credit. Let's get into it. Okay, so these are the two main tools to capture the equity in your home. And we're gonna go over the pros and cons for both and which one fits best for specific scenarios. First, let's talk about a cash-out refinance. So this is going to be very similar to the process that you used getting your first mortgage. We're going to need all of the documentation, your pay stubs, everything like that, and we basically give you a full new mortgage. So say you had a $500,000 property. Say you owe $200,000 on it. You could pull up about 80% usually of the loan to value of your home. So you could pull out a brand new $400,000 mortgage. So you'll have $200,000 worth of equity sitting in your bank account to do whatever you please with it. Now, we suggest making smart payments with this, such as paying off high interest credit card loans, putting some cash back into your home to make that equity work for you even better. So again, this is going to be a new fixed rate mortgage, very similar to the first loan that you got. A HELOC, on the other hand, this isn't a true loan. This is basically going to be similar to a credit card loan. So you will keep that first mortgage that you have. This is very good for a lot of those people that have those low COVID interest rates, 2, 3, 4%, and don't want to get rid of that. So you could take out a HELOC, that home equity line of credit. Basically what this is going to be is you have a credit card and you're going to have a draw period. This draw period is usually about 10 years. This is when you could actually take payments from that credit card. The next 20 years of it will be a repayment period. What's great about these home equity lines of credit is you could use them just like a credit card. So basically, you pull this cash out, you make payments back on it. If you don't pull any cash out of this HELOC, you don't have to make any payments. These are good to have for emergency funds, just for backup. Pros and cons to both. Pros to a cash out is you're gonna get that lump sum. You're gonna have a fixed rate mortgage, just like your first mortgage. And you usually are gonna have slightly lower interest rates, and you know exactly what you're gonna pay. You get that full lump sum. You're gonna get your loan docs. Everything is gonna be set up so you know exactly, you can structure exactly how much you're gonna pay. HELOC is good for short-term projects. Maybe you have an investment property and you need to do some rehab to that investment property. You pull out some cash, you do some work on that investment property, you sell that, you get the cash back, you pay it off immediately. Renos, pay it back quickly. If you pay off your loan, there's usually no prepayment penalty, so it's a very good option for that. What I don't suggest is using this HELOC, taking out cash in your original property, and using that as a down payment on an investment property. And here's why I don't suggest that. Say you're taking that 20% that you usually need for an investment property. You take that off as a HELOC on your primary. You're putting that 20% down, you're financing the other 80%. Basically, you're financing 100% of this property, since you're taking the 20% from your primary, using that to finance, and then getting another loan for the other 80%. A lot of stuff can go wrong in secondary investment properties, so it could work for you, but we don't always suggest doing this. Let's talk about the cost to originate. And what that means is just the cost to get each loan done. So for a refinance, it's usually going to be a little bit pricier. You're going to have to do the same pricing almost as you had to go through with your original loan. With a HELOC, it will be a bit cheaper. Same thing goes for getting approved. For a HELOC, you'll usually have to have a slightly higher credit score since you are taking out a second loan on your home. For a refinance, they usually go up to about 620, maybe even 600, depending on the servicer. Also, for a cash-out refinance, there's usually a lot more flexibility as in what kind of loan program. For example, you could do an FHA or conventional refinance. You could also do a DSCR loan. There's a lot of different portfolio options that you could do with that cash-out refinance, as opposed to a HELOC, where you're just gonna have to do a basic conventional HELOC loan. So here's one of the larger cons, in my opinion, when you have this HELOC. Basically, you're gonna have a high balance credit card that you have total access to. So the temptation may be tough. If you have this credit card and you're not familiar or you're not comfortable with your spending habits, it's very easy to use this credit card and just basically spend it on anything. So be sure to be smart with how you use that money with the HELOC, as opposed to getting that money in a lump sum with a refinance, putting it into your bank account, letting it sit there, and using it for smart finances. So these are vague descriptions for the pros and cons on both, but I hope this helped you understand each a little bit more. But as always, if you have more questions on either of these, feel free to reach out. Thanks.